Hello everyone. In this video, I'll be discussing the accounting for investments. In part one, I'll be discussing the accounting for passive investments. When firms invest in other companies, they do it for strategic reasons and also simply make a return on any available cash. The accounting for investments when buying debt is different from the investments in equity of other companies. Furthermore, the accounting for equity investments varies depending on management's intent to invest in these companies. We'll introduce the concept of a new item called other comprehensive income in this video. The accounting for investments depends on how you classify those investments. If the investing firm does not get to influence the investee firm's activities, then it is called passive. Debt securities and also equity securities with ownership is less than 20% are termed passive investments. Now, when the ownership of equity is more than 20% but less than 50%, they are classified as equity method investments. When equity ownership exceeds 50%, a consolidation method is required. But in this video, we'll focus only on passive investments. Now, let's talk about investment in debt securities. Unlike stocks, debt securities, for example, bonds, have a maturity and hence at which the bondholder receives the principal back from the investee firm. The accounting varies depending on whether the management has an intent to hold the bond until maturity or not. If the management intends to hold until maturity, it's classified as held to maturity security. If not, the firm can either actively trade, and then it's classified as trading securities, or TR for short, or may plan to sell it before maturity but has no intent to trade often. Then it is classified as available for sale security, AFS for short. Now let's take an example. Let's say at the beginning of year one, firm A buys 1 million worth of bonds in firm B, and the bond has a 10% coupon payable at the year end. And in this case, the firm A intends to hold these bonds until maturity. So these securities will be classified as held to maturity, or HTM securities. How is the accounting going to unfold for this purchase? Well, it is straightforward like any other purchase. Investments in securities go up, we call it investments in HTM to be precise, for $1 million. And cash goes out to the firm for $1 million, that will make the balance sheet balance. Now note that there is no effect on the income statement because we just purchased the security by giving cash. Now, year passes. At the end of the year, the firm would have received a coupon of 10% of 100,000. And how will the firm record the interest income? Now, cash has come into the firm, so cash increases by 100,000. Now, it has also generated income, which means if it will affect the income statement, we call it interest income. That will feed into retained earnings. Let's say at the end of the year, the market value of the bond is higher by 50,000, meaning it has gone up to $1,050,000. What will the accountant do? The accountant will record nothing because the firm has an intent to hold it until maturity, and hence it does not care what happens to the value of these bonds. And no change in the market value of bonds will ever be recorded during the lifetime of the bond. Let's summarize the transactions during the year for this investment account. So the firm purchased $1 million, and that will be the ending balance for the investment in debt securities. And on the balance sheet, the firm will report this $1 million in investment in HTM securities. And as mentioned before, HTM securities are reported at cost because value changes are not recorded on the balance sheet. Now let's look at the income statement. Recall that the firm received interest income of $100,000, and that will be in the income statement, increasing net income. Now let's move to year two. Let's say the firm sold these bonds in the middle of year two when actually the value of the bond had gone down to $900,000. How will the firm record this event? Now the accounting for the sale of bonds will be the same as in PP&E, so we'll follow the same steps. So let's do the first thing. First, we need to remove the investment from the books because it has been sold. So we remove $1 million, which is on the balance sheet in investments in HTM. This will remove the investments in HTM from the books. Next, we have received cash of $900,000 on the sale, so $900,000 will increase the asset side of the balance sheet. Well, the balance sheet is still not balancing, but we all know what is happening here. We lost money. So we have a loss of $100,000, which will go into the income statement, and that will again feed into retained earnings. What kind of loss is this? This is a realized loss, representing the difference between the purchase price and the sale price. So it's realized because the firm sold it. So let's see what will be on the balance sheet. Well, because the asset has been sold, the investment in HTM securities will be zero at the end of year 2. Now, on the income statement, the firm will record the realized loss on these HTM securities, which will decrease net income by $100,000. Now, these concludes the transactions for accounting for HTM securities. Let's pause here. If you're comfortable with the material, continue. If not, review them again before proceeding. Moving on to the next classification. We will use the same transactions as in year 1, okay, except that firm A does not intend to hold the bonds until maturity and is likely to trade it on the short term. So the securities will be classified as trading securities, or TR for short. Now recall that the firm A bought $1 million worth of bonds in firm B, and the bond has a 10% coupon. The only difference is we are now classifying it as trading securities instead of HTM securities. Now what will be the accounting? Well, the accounting will be exactly the same. Cash goes out, investment comes in. Now the only difference is now we are going to call it investments in TR to know what classification these investments are. And there will be no effects on the income statement. Now, there will be no difference in the accounting for interest income because the firm would have received interest and it will be recorded in the income statement that will feed into retained earnings, and cash goes up by $100,000. Now, here is where the change begins. So we know that the market value of the bond went up to $1,050,000 at the end of the year. For trading securities, because the intent is to sell, we need to update the value of the asset on the balance sheet as and when the value changes. So on the asset side of the balance sheet, we will increase the value of the investment by $50,000. So the investments in TR will go up by $50,000. And we know that the balance sheet will have to balance, and this is implicitly a gain, so which means we need to put it on the equity side of the balance sheet, and the gains go into the income statement. Notice that this is an unrealized gain because there is a value change, but it has not yet been realized because the firm hasn't sold the assets yet. And the unrealized gain will be recorded in the income statement that will feed into retained earnings through net income. At the end of each period, the value changes that happen for these trading securities will be recorded in the income statement as an unrealized gain or a loss in the income statement, which will then feed into retained earnings at the end of each period. Now let's summarize the transactions for year 1. Notice that we purchased the bond for $1 million. There was an unrealized gain which increased the value of the asset to $1,050,000. So on the balance sheet, you will see the asset value to be represented by $1,050,000 for investments in trading securities. Notice that the trading securities are reported on the balance sheet at the market or the fair value of these securities. Now on the income statement, the firm will record the interest income for sure of $100,000. And there is also this unrealized gain on trading securities of $50,000, the value change that has not yet been realized that will also affect the income statement for year 1. So those are the two effects on the income statement. Now let's move to year 2. The firm sold the bonds in the middle of year 2 for $900,000. How will the firm record this event? Now, as before, we'll follow the same steps, but we need to first remove the asset from the balance sheet, which means we need to remove investments in TR. But remember that the value on the balance sheet is $1,050,000, which is the market value of the assets. So by removing $1,050,000, this removes the investments in TR from the books. Now, cash comes into the firm for $900,000, so we know what the difference is. The difference is $150,000, which is the realized loss on this transaction, which will feed into income and into retained earnings. Now, as I said, this is a realized loss because the firm sold it, but notice that the realized loss here is different from that you reported in held to maturity securities. There we reported $100,000, here we reported $150,000. Why is that? Because the realized gain here or realized losses here is different from what we reported in HTM. It is not the difference between the purchase price and the sale price. It's the difference between the last available market price and the selling price. And that's the difference in the retained earnings amount. Now let's look at the balance sheet presentation. On the balance sheet, no surprise, there is no investments in trading securities. It goes to zero. But on the income statement, we have a realized loss on trading securities, which is $150,000. Let's pause again here because this is a slightly different from what we encountered with HTM. And if you're comfortable, continue. If not, review them again before proceeding. Let's move on to the third classification, investments in debt securities which are classified as available for sale. We'll again use the same transaction as in year 1. The firm A does not plan to hold the bonds until maturity, but it doesn't plan to trade it in the short term either. But it may trade it sometime in the near future. In those situations, these securities will be classified as available for sale. Now, again, we are using the same fact pattern. Firm A bought $1 million worth of bonds in Firm B. The bond has a coupon of 10%. Again, can you do the accounting for the purchase? I'm sure you can. Investment goes up by $1 million. Cash goes down by $1 million. No effect on the income statement. Pretty straightforward, but we're going to call the investments in AFS. Again, no change as far as the interest income is concerned. Cash goes up, retained earnings goes up, and interest income is recorded in the income statement. Now, with respect to the accounting for the value change, recall that the market value went up to $1,050,000. And the accounting is very similar to trading securities with one change. This is where we are going to introduce a new item in the financial statements. So let's start from the beginning. So we know that the value of the asset has gone up by $50,000. So the asset values will record the $50,000 increase in the investments in AFS. Now we have to balance the balance sheet, which means we have to add $50,000 on the equity side. But we don't want to affect the income statement because the firm is not intending to trade. So it is saying that, look, I have no intention to trade. I don't want you to affect the value changes onto the income statement, making it very volatile. Instead, what the firm is going to do is it is going to create a new income statement called Other Comprehensive Income and park it there. So this is going to be a parking spot for items that the firm does not want to put into the income statement. So $50,000 will affect the OCI. Now, because any income affects retained earnings, OCI should also affect something on the balance sheet. So we create a new item called Accumulated Other Comprehensive Income. Now, this is the unrealized gain on the security, which is $50,000, that will go into OCI and feed into Accumulated Other Comprehensive Income. The parallel is very similar to the income statement, where the income affects retained earnings, OCI affects AOCI. So you can think of OCI as another income statement. You can think of AOCI as another retained earnings. So that's the way to think about it. So in this case, the bottom line is there is no income effect or net income effect. It goes into OCI. At the end of each period, again, the firm will determine at the end of each period throughout the time it holds the security, any value changes will be recorded in this OCI and that will go into AOCI each period. So let's summarize the transactions during the year. So the firm purchased a bond for $1 million. There is an unrealized gain of $50,000. So on the balance sheet, the value should be $1,050,000. And that's what you will see on the balance sheet of this firm. Now, in addition, you will also see accumulated other comprehensive income of $50,000 on the balance sheet. Now notice, like trading securities, AFS securities are also reported on the asset side of the balance sheet at fair market value. However, the value changes don't go into retained earnings, it goes into accumulated other comprehensive income, a slightly different item on the balance sheet, but that's how the balance sheet balances. Now let's talk about the income statement effects. There is interest income of $100,000, but there is no unrealized gain in the income statement. However, remember that there is another income statement called Other Comprehensive Income, and there the unrealized gains on these AFS securities of $50,000 are parked. So investors can still see the unrealized gains on these securities, except it is not part of the net income. Now let's move to year 2. Now the firm sells $900,000, and how will it record this event? The accounting for it is similar, but with a slight twist, because remember, there is AOCI lurking in the background with respect to this asset. So let's take the steps. The first thing is we need to remove the investment from the books. So that's one that you already know. So we have $1,050,000 resting in investment in AFS. So we need to remove and reduce $1,050,000. They will remove the investment in AFS in the books. Cash comes in of $900,000. But remember that there is a component of the security sitting in AOCI. And once you sell the security, we don't need that AOCI anymore. So we need to remove the AOCI from the books. And that's what we will do next. We will remove $50,000 from the AOCI. Now, the moment you make a change in the AOCI, you should also make an effect on OCI, because after all, these two are connected. So we will reduce OCI by $50,000 in order to make sure that the income statement and the AOCI are connected. Then, in order to balance the balance sheet, we need to record the realized loss of $100,000, which goes into the income statement. Now, this is the realized loss, the difference between the purchase price and the selling price, that is the 1,900,000, which goes into the income statement. So you can see that by available for sale, you're only recording the losses or gains on an asset when the asset gets sold. In the interim, any value changes sits in AOCI, and that's the way to think about the available for sale securities. Now let's look at the balance sheet effects. We know that because the asset has been sold, the investment in AFS securities will be zero at the end of year 2. And on the income statement, you will have a realized loss on AFS securities for $100,000. And at the same time, you will have a reversal of the unrealized gain from the past of negative $50,000, just to kind of ensure that we don't double count the unrealized gains from previous times. So this concludes the transactions for the debt security under the 3 classification. Moving on to investment in equity securities, that is stocks. Investment in stocks where the ownership is less than 20% are classified as trading securities. Notice that equity securities cannot be classified as held to maturity because they don't have a maturity. And then they cannot be classified as available for sale option either. And the accounting for trading securities, equity securities, is identical to that we used for debt securities. So there is no difference. The only difference is that instead of interest income, the firm will record dividend income if the stock pays dividends. This concludes the video for accounting for investments, and particularly passive investments.